G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, we're going to be diving into Dropbox's Q1 2022 earnings report, and we're going to be discussing how they went and the results that they put out. So before we get into it, make sure you like this video and subscribe to my channel. So whenever I look at a company that I have money invested in, whenever I read their quarterly earnings, I always like to compare how the company is doing to my original investment thesis. So I might just sound off my investment thesis for Dropbox really quick. So I made the investment because I saw a business that had recurring revenue. It was ultra consistent and it was steadily growing. I could see that they were growing their user growth by, they were growing their users on the platform by like 300,000 every quarter. And this was super consistent. And I could see that they were also growing their average revenue per user, which was creating margin expansion, which was causing the company to produce free cash flow and grow their free cash flow at an even faster rate than their revenue. And on top of that, the company came out and they said that they were looking to hit $1 billion in free cash flow by the end of 2024. And when I looked at the valuation, you can look at the valuation today. The company's trading at about an $8 billion valuation. And I was thinking, well, this company consistently hits their targets and they are usually quite conservative. So, I think it's very likely that they're going to hit this $1 billion in free cash flow by the end of 2024. And if you just put a 10 multiple on that, that gets you at, a $10 million market cap. That's not a great return, but even, companies in the same industry as Dropbox, they trade well above 20. I think the industry average for a multiple is about 24, and I think Dropbox should at least trade at a 15 at least, and that puts you at a double from today's share price within 2.5 years. So that's kind of where my thesis was at with Dropbox. That's very high level. Obviously, it's a lot deeper than that, but as you'll see with these results, nothing's changed my thesis. So I'm more confident than ever in my investment. So total revenue, look, it grew just under 10%. And this is what it does pretty much every quarter. It grows, somewhere between 8 and 12%. That's where they grow their revenue at every quarter. Nothing's changed. That's fine. That gets the tick. Total ARR, so this is total annual recurring revenue. So it's at 2.29 billion and that increased 8.4%. It's well within their normal range. Nothing's changed. Paying users. Look how much that's increased year over year. They've gone from 15.83 million all the way up to 17.09 million. And they even lost some users this quarter due to the war between Ukraine and Russia, and Dropbox pulled their operations from Russia. So despite that impact, they've still grown their paying users. And the company did come out and they said that in terms of total revenue, it will have a high single-digit $1 million impact. So it's nothing too crazy. Russia is not a big market for Dropbox and they're relatively unaffected. Average revenue per paying user. What do you know? It's gone up a couple of dollars compared to last year, and this is consistent with what they do every quarter. GAAP gross margin. It's almost 80%. Now, that's an extremely high GAAP gross margin, and you can see the non-GAAP gross margins, they're increasing. It's gone from 80.2% to 81.3%, and the reason for this, average revenue per user is going up. If that keeps going up, gross margins are going to keep going up. It's the same story with their GAAP operating margin. It's pretty much doubled since last year. They've gone from 8.3% to 15.9%. Non-GAAP operating gross margin. It hasn't changed so much, but it has increased. Now, the reason for this large operating margin increase is a lot due to their shift from working in physical offices into virtual workspaces, where in fact now they're not paying a bunch of capital leases. So capital leases was hurting their profitability before, but now they don't have to pay them because everyone is working from home. Also, it's meant that they're able to recruit software engineers in markets where you don't have to pay them as much. So previously they were recruiting in hubs, tech hubs, where the average wage of the software engineer is much higher. And now they can go and attract talent from other areas because it doesn't matter where you're living if everything's done on a virtual workspace. What about operating net cash provided by operating activities? It also increased. It went from 115.7 million to 141.4 million. And subsequently, free cash flow also increased because their capital expenditures are very light. And if you have a look back at some of the Warren Buffett shareholder letters from the 1970s when we had higher inflation, what did he say? He said, you want to own businesses that produce free cash flow and are capital light. Well, we see this. We've got high margins, we've got low capex, and we're producing a shit ton of free cash flow. If we have a look at this, EPS, it pretty much doubled if you're looking at GAAP EPS. And if we're looking at non-GAAP EPS, it grew slightly. Nothing crazy here, but it's fine. Just look at the rest of the numbers. Has the thesis changed? No. Cash equivalents and short-term investments. It's at 1.5 billion. And I mean, this gives them flexibility. So if they go out in there and they see, oh yeah, we want to do some mergers and acquisitions, well, hey, you got the cash there on the balance sheet to do so. Especially in this market where there's a lot of beaten down assets. Maybe Dropbox go and find a company that they like and they go buy them for half price of what they were maybe a year ago. And then with that money as well, what else can they do? They can buy back shares, and they've been buying back a shit ton of shares. And the company the board at Dropbox has authorized another $1.2 billion in share repurchases. So, that's another. If you think about their market cap's at 8 million. If they go and buy back 1.2 billion of shares, they're buying back well above 10% of the company with those repurchases. And you can see this is evident here. In 2021, they had diluted weighted average shares of 405.4 million. But this year it's reduced all the way down to 372.9 million. And one of the biggest complaints that I hear about Dropbox is that they have a lot of share-based compensation. And yeah, that's true. But compared to their competitors, it's actually not so bad. And the company is that profitable now that it literally doesn't matter because you can see them buying back a lot of shares. This share count is decreasing at quite a rapid pace. So quite frankly, that argument, is valid, but it just doesn't matter. They're producing so much cash that the stock-based compensation is increasingly becoming smaller compared to the amount of free cash flow the company is pulling in. So let's talk about valuation. So let's just be straight up. It's looking really bloody cheap, and it's at the moment it's trading at 11.75 price to free cash flow ratio. This is pretty much the lowest it's traded at in terms of price to free cash flow ratio since September 2018 of its IPO. We can see the mean. It's traded at about 20. So for my valuation models, I'm going to use 15. I'm going to say, hey, we might not be growing as fast as we used to, but we're producing a lot of free cash flow now. Let's call it 15. I think that's still pretty low. I actually do think 20 is pretty fair. But regardless, we're going to call it 15. It's a high margin business, capital light, growing revenues, roughly 10% per year, and they're buying back shares like crazy. So let's jump over to Excel. This is just a quick and dirty valuation here. So I do think they're going to hit that $1 billion in free cash flow by 2024. I think they'll have shares outstanding of about 350 million. As you did see before, they did have shares outstanding of currently of about 372 million, if I remember correct. So I do think that share count is going to come down because they're going to be buying back shares religiously, probably for the next many years. And a free cash flow multiple, I just justified that. I think 15 is fair. So put that all together and we get a 2024 target price of $42.86. And because that is about 2.5 years away from now, and if we put in a current stock price of $21.14, that gives us a compound annual growth rate of 33% per year. So honestly, it looks like a very attractive opportunity. Obviously, this isn't financial advice. This is just my opinion. You've got to make up your own mind. But from my own perspective, this looks like one of those low risk, high reward situations where you got a business that's ultra consistent. 80% of the users use it for work. So they're going to use it regardless of the economic conditions. We're seeing retention rates and churn for Dropbox subscriptions decrease and retention increase, which is a testament to their new acquisitions, HelloSign, DocSend. It's keeping people on the platform, and they're growing the ARPU. They're growing the users by 300,000 every quarter. Management is executing, operating margin 30%. It's really quite impressive. So anyway, guys, I'm starting to ramble, but I hope you enjoyed this video, and I'll see you in the next one.